Good morning. Um, Welcome to warm weather, huh? I couldn't believe this morning that it said it was -16 when I got up. So you brave souls who are here, and then I hope those online are home warm. Today what we're going to be doing is we're going to be talking about the first half of Chapter 5, and then Wednesday the second half. Before we get there, there is a question right now in learning catalytics. It's, again, some of those fundamental things that you'll continue to need to know throughout the term. What type of account is accounts receivable? It's in learning catalytics right now. Again, participation-based today. I'm going to go over the answer. We're going to leave the question open for another 1 to 2 minutes. So even after I go over the answer, it will still be open in Learning Catalytics till we get to the next question. So what type of account is accounts receivable? At this point, you should be recognizing that that's an asset. Accounts receivable are amounts that other people owe us. And that's one of the topics in this chapter that we're getting going on is how do we deal with accounts receivable. Accounts receivable typically arises in business due to selling our services or our goods to other companies, and they say they'll pay us within 30 days. That's an accounts receivable. If you go to the doctor's office and you say, I'll pay within 30 days, and you don't pay cash that day, the doctor's office has an accounts receivable with you. Okay, so that question will stay open. What's due this Saturday is the Chapter 5 homework. Okay, the exam. So I'll talk a little bit about the exam, some general observations I had. The entire list of exam scores, of course, without names, can be found at this URL. It's tiny.cc/exam1 spring 2015. It is a PDF document, so it lists all the exam scores sorted from high to low. There were 15 people who got 100% on the exam. Okay, so good job. There were several people who got close to 100. Excellent results there. The average on the exam was 72.4%. The median, meaning half the class scored above 74, and that's actually a little bit higher than where I expected, so that was good. And so this is the list. So if you want to see, I sorted it by high to low, and then I put ranking numbers just 1 to 554 on there. And you will notice we had an incident of cheating, clear-cut cheating, and that person got a 0. And I haven't had an incident of cheating in 2 years, so it was not a good day for me or for the other person. So I hope that doesn't become you, so think twice before you make those choices. 554 people took the exam, and you'll see the scores. Now, again, it is a PDF document. It's tiny.cc/exam1 spring 2015. If you would like to see your exam, the way you would do that is you would come in and go over your exam with Haley. She has time this week. We don't want to let it go any further past this week because typically she doesn't have hours for other than what we're doing in class. So this week she will have hours on Tuesday from 10:45 to 1:45. That is a 3-hour window, and on Wednesday from 11 a.m. to 1 p.m. She can go over your exam usually 5 to 10 minutes. It doesn't take long. You just stop in. No appointments necessary. She'll be in room 579 in the College of Business. If you absolutely cannot make those hours, email me and we will see if we can find another time slot that she can hold but try within those hours. She generally has a pretty steady stream, but the line doesn't get long, so you'll be able to see it. So the things that I observed when people didn't do well, there was a case where I looked at someone, and this person had taken the practice exam one time and had spent 4 hours on it, and then went to take the exam, didn't do well. And my conjecture when I look at that, I think, well, every time you take the practice exam, it's different. So you also, if you spent 4 or 5 hours on the practice exam, you were looking up a lot of stuff. So maybe you weren't prepared totally for the exam. The practice exam, when I saw people do the practice exam like 4 or 5 times and were scoring very, very high, generally the exam score was correlated with that. That was what could be expected. But again, Haley can go over your exam. The next exam will be similar, so that's kind of what to expect. The same thing, we will have a practice exam. I'll provide a sheet of notes of equations that you would be able to use. And if you are in sections 5 or 6, just a reminder, you can sign up with ProctorU anytime for exams 2 and 3. You don't have to wait. They are available. Okay. So again, the list of exam scores is at tiny.cc/exam1 spring 2015. Okay. And I sent an announcement out. It's in your email. It's also an announcement on Blackboard listing these times that you can see your exam with Haley. So I would encourage you to go see your exam. Okay, so this chapter is about short-term investments and receivables. So what I've got on the screen here, the numbers aren't important as much as this is Coca-Cola's annual report. Coca-Cola's publicly held, so they have to file their financial statements every year with the SEC. This is their 2013 financial statements. Their 2014 financial statements are going to be issued in the next couple weeks, at probably about the end of February. So right now we have 2013 to look at. What I have on the screen, it says the Coca-Cola Company and subsidiaries, consolidated balance sheets. Consolidated balance sheets means that this is all of Coca-Cola's subsidiaries added together. When Coca-Cola prepares financial statements, it's for the entire company. So it's Coca-Cola and every subsidiary they have. So if they own different brands, that's going to be included in their financial statements. So everything they own is in these financial statements that we know because it says it's consolidated. Now this is the partial balance sheet. This I got directly, I just took a screenshot from their 10K, and a balance sheet always starts with assets, and specifically it starts with current assets. And the very first asset on a balance sheet is going to be cash. The next one, Coca-Cola, I've circled it in red, is short-term investments. And then the next one down is marketable securities. Those two items are what we're going to start talking about in this chapter. So where we are is, and for the next several weeks, we're going to be pretty much working our way down the balance sheet. So right now we're starting towards the top of it. Then we're going to do accounts receivable later this week. Then next week we'll be doing inventories. We'll be getting into some of the long-term assets after that. So we're just going to work our way down the balance sheet. Then after the assets, we'll do the liabilities. So that's kind of our plan for the whole semester, is to work through that balance sheet. So starting with short-term investments and marketable securities, that's what we're talking about today. We're going to come back to Coca-Cola's 10K report after we've talked about it, and I'll show you what they say about their short-term investments and marketable securities. Short-term investments are going to be cash within 3 months. They're really, really short. Marketable securities may or may not turn into cash in the next 3 months, but they're still less than a year. Okay, so another new question in learning catalytics. This one is a word cloud, and Coca-Cola, just a fun fact here, participation-based, Coca-Cola is sold in every country in the world except for 2. So try to name, without Googling it, try to name one of those 2 countries. If your answer is 2 words, put double quotes around the 2 words or an underscore between them to force your answer into 1 word. Okay? Yeah. Okay. Yes? What? Okay. Okay. It's right up there at the top. Session ID is at the top of the screen on the left, 4955-1999. Just I didn't hear you at all. That doesn't make any sense. Well, are you in Learning Catalytics?
Yeah.
Okay. Yeah, Learning Catalytics. Okay, we're going to close this question in about 10 seconds. Name one of the only 2 countries where Coca-Cola is not sold. Okay, and the 2 answers are North Korea and Cuba. Okay, so Coca-Cola is sold in some form in every other country in the world other than Cuba and North Korea. So that was just an interesting fact. We're going to come back to Coca-Cola's financial statements after we talk about this chapter. Let me stop sharing. Again, sign into Learning Catalytics directly. You do not need My Accounting Lab to get into Learning Catalytics. Go to learningcatalytics.com, and Haley is just put the URL. Okay. Okay. Now we're going to be talking, starting in this chapter, we're going to start talking about how to account for short-term investments. And these are investments that come right after cash on the balance sheet. So we have cash and we have short-term investments and then accounts receivable. As a side note, I should mention, we skipped cash. Cash is going to be in Chapter 4. We did skip Chapter 4. We are coming back to Chapter 4 in a few weeks. Chapter 4 is a very small chapter, and I want to put it in the same week. It's not a whole week's worth of chapter, and neither is Chapter 8. So I combined Chapter 4 and 8 in a couple weeks from now. So that's why we're on Chapter 5 today. Okay, so reasons companies invest in other companies because they have excess cash, number one. They may have extra funds and they need to do something with it. So they'll buy stock or debt securities in other companies. That might be one reason. Another reason they invest in other companies is they want to control their suppliers. Apple may buy the company that produces glass for its devices. Apple may want to control supply chain above it, so it'll buy different things. That's very common for companies to buy other companies to be able to control them, their supply chain. Also, they may just have cash available. Short-term investments are considered to be a current asset. And then there are 3 types of short-term investments, three types of investments: trading, available for sale, and held to maturity. And here I'll give a plug to the PowerPoints I've put on Blackboard. They're more detailed than this, so they'll give a little bit more information. So if you have those PowerPoints, you'll see that I'm going over the high points, but there's more details in those PowerPoints. Okay. Okay, so this idea that there's three categories of investments. We have trading, available for sale, and held to maturity. Trading securities are expected to be sold in the near term. How we classify something as trading is completely our intent. So management will buy a security and will say, we plan to sell this very fast, like within 30 days, and that's considered to be a trading security. And then we have trading securities that might be sold in the, we have securities that might be sold in the future if the time presents itself right, that's available for sale. So the way we classify a security as trading or available for sale is management's intent. So do we have the intent to do it, and do we have the ability to hold on to it? So those two things say whether it's trading or available for sale. Okay, then held to maturity. Held to maturity is a debt security that has a due date. So if I go buy a bond in a company, there will be a maturity date on it that says the company has to pay it back on this date. That has a maturity date. So a company can buy bonds and say, we're going to hold them until they mature. That's a held to maturity security. And a stock can never be held to maturity because it doesn't have a maturity date. So we have this trading or available for sale and then held to maturity, those three categories. So we're going to talk mainly about trading securities and what we're coming up. And we're going to try to keep it at a real high level, not go real far into depth, but we're going to start with an example. Okay, so we're going to just go through. Suppose on June 18, 2014, Apple purchases 5,000 shares of Intel stock as a trading security. It's a trading security because they told us it was, and it's because management has the intent to sell it soon. And for simplicity, assume that this is their only short-term investment, so we don't have to worry about other investments in our portfolio. Intel buys the stock for $20 a share. Apple buys the Intel stock for $20 a share, paying $100,000 in cash. Okay, so $20 a share times the 5,000 shares. And when we record this investment, what's happening is we now have an investment in trading securities for $100,000, and we have cash going out for $100,000. Okay, so it's just like before. We have a short-term asset now called investment in trading securities, and or some type of investment, and then we have a credit to cash because we spent cash for these securities. Okay, so this was the purchase of a trading security. The next thing that can happen when we have an investment, one of the other things that can happen is we can get dividend revenue on it. So the next thing is going to say, okay, so on June 30th, Apple receives a dividend on the stock that it bought. Now it tells us it's $4,000. Typically, dividends are expressed on a per share basis, but they're just telling us $4,000. So what's happening there is Apple is getting $4,000. So cash is going up, and then what's being credited here is dividend revenue. Okay, so they're getting cash and they're earning dividend revenue. Okay, now two more things that we have to know about these investments. Now, trading securities are kind of a unusual animal in that they are so close to cash. They're something that we intend to sell soon. It's almost cash, So what we do with trading securities is if a financial statement date comes along, we have to measure their current value, their fair value, and then we have something called an unrealized loss. So we're going to go through that. Okay, so with trading securities, we have something called an unrealized gain or unrealized loss. The big key there, the big special word here, very specific accounting terminology, is going to be this word unrealized. If you see the word unrealized, that means that the company still owns these trading securities. It means that we got to a financial statement date, we still have the trading securities because maybe we've only owned them for a short period of time, but we have to, at the financial statement date with trading securities, figure out their fair value. Now, and fair value, market value, that's what it means. We have to look up. And if it's stock in another company, it's pretty easy. We look up the current market value, market shares as of the close of business on that day, and that's what we're comparing. If the fair value has increased from when we bought it, it is an unrealized gain. If the fair value has decreased, it's an unrealized loss, which makes sense. Let's compare what we bought it for what it's worth now. Do we have a gain or loss? And if we are still holding it, it has the word unrealized. Okay. So if you see the word unrealized, that's an automatic trigger to you to know the company still owns this investment. Okay, that's what unrealized means. And we treat it a little bit differently. You'll see that down the line here. Okay, so let's go through an example. Let's say Apple's fiscal year ends on September 27th. It ends around there each year. They have like a 53-week year. On this date, the fair market value of Intel stock is $110,000. So Apple has to adjust the investment to its fair value. What it's going to do is it bought it for $100,000. It's now worth $110,000. So we have a $10,000 gain, but it's not a gain. It's an unrealized gain, and that investment is worth $10,000 more. So we're going to have our asset go up by $10,000, and we're going to have our unrealized gain go recognize an unrealized gain by crediting it. Unrealized loss and gains follow the same debit credit rules as regular gains and losses. But that word unrealized is huge. That means Apple still owns this. Do a lot with this in Corp 2 or Corp 1. Fair value. Yeah, if you're an accounting major, you get a lot further in depth to this. Okay, so this is when the market value is greater than the cost or the original cost. So Apple bought it for $100. It's now worth $110. So what's happened here, we're going to increase the value of our investment, and so that $10,000 from the journal entry gets added to the investment. So our investment has a balance of $110,000 after this, and then the unrealized gain on trading securities goes in other income as a gain. Okay, now that's a gain. We're going to do a loss too, just so you can see it's backwards from what we just did, because with a loss, the investment value goes down. So let's say, I guess I don't have an example of a loss here. Okay, so if we had a loss, you can just do arrows. If we had a loss, we would be debiting unrealized loss, and we would be crediting the investment, because that would make sense, right? The investment would go down. We want to credit it. So a loss is the exact opposite of what we've got on the screen here. Okay, so we've done the purchase of a trading security. We've done the receipt of dividend revenue on as trading security. We've done these unrealized gains and losses, what happens when we get to a balance sheet date and we still own it. We have to mark it to fair value, so we have this unrealized gain or loss. Now the next situation is a realized gain or loss. And the word realized is kind of redundant there. You would not see the word realized anywhere. We're using it here to distinguish it from everything else that we're talking about. So realized simply means that it's been sold. So you typically would not see the word realized, okay? But we're using it to show the difference. You have to see the word unrealized if it's not sold. But realized you would not see until it's sold. So realized gains and losses only happen when the investment's sold. If the sales price is greater than the carrying amount, you have a realized gain. And if the sales price is less than the carrying amount, you have a realized loss. And again, I want to emphasize that this word realized is typically not included. You don't look at a financial statement and it's not going to say realized gain. It's not going to say realized loss. It'll say gain or loss. That means it was sold. Okay. If you see the word unrealized, that means they're still holding it. So unrealized is the real trigger to tell you they still own it. So we're going to go through an example of a realized gain or loss here. Yeah, gains and losses are separate, and there is an unrealized gain account. There's an unrealized loss account. So with Apple, let's say they sell the Intel stock on June 19th for $107,000. So what's going to happen there is they're getting cash of $107,000, so cash is increasing. They have investment in trading securities of $105,000. Somehow I jumped from $110,000 to, I must have left out an example. I think I did. Okay, so let's do this. Let's make this assumption. Let's assume that when they sold it, their carrying value, this is actually, we skipped a part here, not critical to what we're doing. That is its carrying value, unrelated to the prior carrying value. There was an example I skipped that was its carrying value is what we have it on the books for at the date of sale. So they sold for $107,000. The carrying value on the date of sale is given to us as $105,000. So the difference between what we sold it for and its carrying value is $2,000. It's a gain because we sold it for more than we're carrying it for. The carrying value is the original cost plus or minus the adjustments to the fair value adjustments we would have made. Okay, now we're circling back to Coca-Cola's financial statement. Okay, so in none of the Coca-Cola stuff, you don't need to memorize it. I just want to show that this is seen in real life. It's not just stuff we see in the book. And this is going to be small. I'm taking the Coca-Cola 2013 Form 10K, and this is actually from page 89. Now, when you have a financial statement, you file with the SEC, there are several pages. So Coca-Cola's financial statements, their 10K, the 2013 10K, is probably about 130 to 150 pages long, okay? So when you open it up, the first 75 pages or so is information, disclosure they're talking about that's required by the SEC. The SEC governs everything that's in there, and then U.S. GAAP provides guidelines for the accounting rules. But you have to go pretty deep into the 10K to find the financial statements. So Coca-Cola's 2013 10K, the financial statements are around pages 74, 75, 76. There's probably 6, 7 pages of financial statements. And you'll see the balance sheet, you'll see the income statement, the stockholders' equity statement. And so there's the financial statements. Then after that, there's probably 50 pages of notes to the financial statements. Yes. The question was, do all publicly traded companies have to make their 10Ks public? Yes. The SEC actually has a database called the EDGAR database, and that is a database of all the 10Ks that are filed with the SEC. So a 10K is the annual report, so every company that's publicly traded has to have a 10K on there. And 10Ks are the annual filing. Companies also do quarterly filings. Those are the 10Qs. And then there's a slew of other filings companies do. But when you open up a 10K, the first time it just seems overwhelming because it's 150 pages. You have to go 75, 80 pages in to get to the financial statements. So you have these financial statements. But it isn't just about the financial statements. There are also notes to the financial statements. And these notes to accompany the financial statements tell us a lot more information about the company. So when we started off the chapter, I'd shown you their balance sheet where they had short-term investments and marketable securities. So, okay, you can see what the balance was in 2013 and 2012. They have to present at least 2 years of balance sheet data and 3 years of income statement data. This is all governed, very, very uniform across different companies. And if you go to any company's investor relations website, they'll have all their reporting forms on there as well. Okay, so anyways, then we have the financial statements, so then I dug into the notes and said, what can we see in the notes about Coca-Cola's investments? There's an actual note they have. Note 3 is about investments. It's fascinating what you can find in the notes to financial statements. So as we go the rest of this semester, every chapter we'll dig into some company's statements and see what they say about that. So this is their investment note. And I've tried to highlight, and it's very small, but the first sentence says, investments in debt and marketable securities other than investments accounted for under the equity method and not classified are classified as trading, available for sale, or held to maturity. So what that first sentence tells us is that Coca-Cola is classifying their investments into those same 3 categories that we just talked about. They're following U.S. GAAP, which we would expect. Now, just as an aside, accounted for under the equity method, so it says other than these. If a company holds more than 20% of the stock of something it buys, so it goes out and buys 25% of the shares of something, then it's considered to have 25% or 20% or more of the shares of a company. It's considered to have significant influence, and it has to account for it differently. So all the assumptions we're making in this chapter, we are saying the companies are not purchasing more than 20%. If you're purchasing more than 20%, you get into 2 different accounting methods, and that's a accounting major topic for a much later class than this. So we're just making the assumption. So we don't have to worry about that equity method it talks about. So the first sentence, they use the same 3 categories that we did. Then further down, it tells us realized and unrealized gains and losses on trading securities and realized gains and losses on available for sale securities are included in net income. So they're telling us they have unrealized gains and losses and they have realized gains and losses. And then it tells us unrealized gains and losses on available for sale securities are in our consolidated balance sheets as a component of other comprehensive income, which we'll see in a minute here. And then it tells us in the bottom, the company had net unrealized gains on trading securities and net unrealized losses. And so in 2012 and 13 they had gains, and 2011 they had loss, which makes sense if you go back and think about the stock market in those periods of time. But that sentence right there is talking about unrealized. What that means is it valued, Coca-Cola had to get the current value or the fair value of all its trading securities at balance sheet date in 2011, 2012, 2013. 2011 it was a net loss. 2012 and 13 it was a net gain, and those were unrealized. They hadn't sold them yet, but they've adjusted them to fair value. Okay, so continuing on with the note, we also have a note, reoccurring fair value measurements. It tells us, the first highlighted, the only assets and liabilities that are adjusted to fair value on a recurring basis are investments in equity and debt securities classified as trading or available for sale. Okay, so they're telling you that they don't go revaluing all their assets. The only assets they revalue on a regular basis or reoccurring basis are these investments in equity and debt securities. Equity securities are stock in other companies. Debt securities are bonds that they're buying. So they're telling us that these are the only assets they do this for. So they're not out saying, oh, let's revalue this bottling plant that we own. They're looking at their debt and equity securities. And then it tells us, the second highlights the fair values of our investments in trading and available for sale securities. We do that using quoted market prices from daily exchange traded markets. Okay, so those are they call it actually level 1, that's not an accounting term, but they're saying for their securities that are publicly traded, they take the closing value at the close of business, and that's what they use for fair value. Then it goes on to tell us that the securities they have that aren't in these exchanges, then they use other criteria to get their fair values. Okay. Okay, so here is their consolidated statement of income. So this is Coca-Cola. So now I'm out of the notes and back into the financial statements. This is page 74. First of all, it says consolidated statement of income. That word consolidated just means it's all of Coca-Cola's subsidiaries blended together. And the very bottom line, we have net operating revenues, we have our gross profit operating income. Down to the bottom, we get consolidated net income. Now, the very next statement we have not talked about until now because it wouldn't have made any sense. And it's pretty much beyond the scope of our class, but I wanted to show it to you anyway. So this is their income statement. Their income statement ends with consolidated net income. Actually, if you look at their income statement, it's much longer, but it goes into earnings per share and things like that. I did need that, so I just ended it here. So we have the consolidated net income. Then the very next statement is something called a consolidated statement of comprehensive income. A consolidated statement of comprehensive income is beyond the scope of our class, but this is where those adjustments to fair value on the trading securities go. They're not normal gains and losses. That's why they're called unrealized, because they're segregated. We see that this consolidated statement of comprehensive income starts with the comprehensive net income from the statement of income that we just left. And then down below in the light purple, I've highlighted, there's a lot of things on this statement, but here's where unrealized gains and losses on available for sale securities go. That's not something you need to memorize, but when you do look at one of these financial statements, there is this other statement lurking there. And all we're going to do pretty much is say that this is beyond the scope of our class, but we do have these unrealized gains and losses that end up in this, it's called OCI, it's the lingo when we talk about OCI. So anyways, I just wanted to show you how investments show up on Coca-Cola. And if you were to look at any company with a 10K and they have any investments, you're going to see similar things, and it's going to give you information. So, as we go in each chapter now, we'll start looking at these 10Ks that companies have. And they can be quite fascinating, but keep in mind you're not looking at just the financial statements. The notes have a lot of good information in there. Okay, so let's go back and do a question now. So short-term investments can be divided into held-to-maturity securities, trading securities, and available-for-sale securities. Is that true or false? That is a question out there for you. Yes. Mm-hmm.
There was a action that wasn't in parentheses. You don't have to put in parentheses because it states that it's less.
Are you talking? Mhm. Mhm. Yeah. Yeah. It's telling you. It's telling you that that's less, and so you wouldn't necessarily do it. And I don't know that there's precise conventions, but you can eyeball and see that they're not. Yeah. I would have guessed that they wouldn't put the word less, and it would have been a parentheses around it, because again, but yeah. Okay, short-term investments, we have about 10 seconds left to get an answer in on this one. Short-term investments may be divided into held-to-maturity securities, trading securities, and available-for-sale securities. True or false? Okay, and that is true. Those are the three categories, which you should know the three categories. I've actually, I think, got 3 questions right in a row here. Okay, next question. An unrealized gain occurs when a company sells a trading security. True or false? Okay, about 10 seconds left on this one. Most of the answers coming in. Okay. Unrealized gain occurs when a company sells a trading security. True or false? Okay, and that is false. And the reason that's false is when you see the word unrealized, it means the company has not sold it yet. See, that unrealized word needs to trigger in your mind an association with, I'm still holding it, I have not sold it yet. Okay, this is market value or fair value. And then one last question before we go on to the next concept. Okay, a company will have an unrealized loss if the fair value of the investment is greater than its cost. True or false? Okay, about 10 seconds left. Okay. And that's false. An unrealized loss occurs if the fair value is less than the cost. So think about what the cost is. Loss is going to be if the fair value is less than what it costs, not if it's more. Okay, we're moving on to the next learning objective then. We're kind of leaving there we go. So leaving trading securities, and now we're moving on to some terminology we need, and then we'll be, okay, so looking at revenue recognition. We talk about revenue recognition in a couple different chapters because it is so important. And it seems like it should be easy to say, well, we know when we've earned income and when we've not. And sometimes there's cases where it's not as obvious. The rules for revenue recognition is we recognize revenue when the goods are transferred or the services are provided. And you think, well, that's pretty easy to distinguish. And it is. If you're going into Starbucks and ordering a drink, when they hand you the drink and you hand them the money, that's pretty clear that the goods have been delivered, okay? But then start thinking about, well, what happens when you place an order? When I order something from Amazon, and it's in California, and when I place that order, does Amazon recognize the sale when it leaves their warehouse or when I get it? And in that case, consumer goods have a set of rules. But when you're buying, if a company is buying from another company, when I worked at Plastic Lumber, we routinely ordered bales of milk jug, which you would think that they weigh about 900 pounds. So the milk jug that you discard, that you wash out and they cube it. They put it in big cubes, municipalities do, and then they're sold as commodities. So we would buy bales of milk jugs from different cities, and then you think about, when does the city recognize the sale? When they ship it or when we get it? Because it has to be the same moment. Someone owns that, so we talk about, so that's what we're talking about here, is when do we recognize the sale? When it leaves us or when it gets there, and there's rules that govern that. Okay, to recognize revenue, we also have to have the price be fixed. It can't be loose. You know, we have to agree on a selling price, and collection has to be reasonably assured. Okay, so revenue is the cash value of what you sold. It's your selling price. It's what the cash value of that. It's impacted by shipping terms and payment incentives, and that's what we're going to talk about in this learning objective, our shipping terms, knowing when revenue is recognized depending on when you ship it, and payment incentives. So we're going to go through this. Okay, so let's talk about Apple. Assume that Apple delivers a truckload of iPhones to an AT&T wireless warehouse. On the truck are 30,000 iPhones, each of which Apple sells to AT&T for $100 on account. So when Apple does this, they're going to have accounts receivable for $3 million because we have 30,000 phones, $100 each. So Apple's got a receivable for $3 million and has sales revenue for $3 million. Okay, now we're going to see some situations that are complicated by shipping terms. When Apple sells those iPhones, does title transfer when it leaves Apple's warehouse or when it gets to AT&T's warehouse? And the title transfers at one point. Each company doesn't just pick, okay? There is a title transfer that takes place. That's when revenue is recognized. So that's what we're going to do now, is talk about these two terms. Okay, first term, FOB shipping point. FOB stands for free on board. It's an old term. I don't know why they started using it, but it's FOB shipping point, and we have FOB destination. You have to know the difference. When companies make purchases or sales, they'll have the shipping terms specified, and this makes a big difference as to when title transfers and when revenue is recognized. FOB shipping point. FOB shipping point means that ownership changes hands and revenue is recognized when the goods leave the shipping dock. So FOB shipping point means that at the seller's dock, once the goods depart, then title transfers and revenue is recognized. So that's FOB shipping point. Yes, revenue is recognized at the shipping point for FOB shipping point. And the buyer recognizes it, the purchase at that point. Title transfers at that point. And then FOB destination, the title doesn't transfer until the goods get to the customer. Yes. Does anything change if you're using a third party to, pardon me? Mm-hmm. Mm-hmm.
While they're in control of whatever the product is it always going to be one of these?
Yeah, it doesn't. If you use UPS or FedEx, it doesn't change this at all. You know, there's some legal things like UPS and FedEx have some responsibility if they screw up, but the title still transfers using these rules, even if you're using a third-party shipper. Okay, so FOB shipping point, title transfers at the shipping point, and the sale is recognized then. FOB destination, the title transfers at the point of delivery to the customer. Okay, so that's one thing that can impact no, we're coming back. I'm just going out of order. Okay, so sales discounts. We also have sales discounts. Sales discounts are discounts offered for early payment. Okay, so when I make, as a seller, I sell my goods and the buyer says I'll pay you in 30 days. So we negotiate these terms. As a seller, I want to speed up my cash collection for at least two reasons. Number one, I need cash to pay my suppliers. Number two, the longer someone owes me money, the more chance that they'll default. So I want to shorten up my cash receipt cycle. So oftentimes, as a seller, I'll offer a sales discount. A sales discount, very specific terminology. The word sales discount does not mean, oh, we're marking it off 50%. Sales discount is specifically a discount offered for early payment. Now, when we have a typical sales terms or financing terms, you might see 210 net 30. That's how that's pronounced. 2/10, N/30 is 210 net 30. Okay? And let's talk about what all those pieces mean. The 2 means that there is a 2% discount offered if this invoice is paid within 10 days. So that's what that 210 means, the very first of it. 210 means 2% within 10 days. You might see 1/15. That means a 1% discount is paid within 15 days. By the way, a 210 discount, 2% discount for paying within 10 days, that's huge. If you did that on an annualized basis, if you saved 2% for paying within 10 days and it's due in 30, that means you're saving 2% for 20 days early payment. So anyways, okay, so 210, and then the other part of this, the net 30 means that if you don't pay within the discount period, the whole amount is due within 30 days. Okay, so now let's do that example. So discounts offered, sales discounts are discounts offered for early payment. A typical incentive is 210 net 30. So let's assume that Apple offers AT&T terms of 210 net 30 and AT&T pays the invoice within 10 days. So if AT&T pays that invoice within 10 days, it's entitled to a $60,000 discount, which is the $3 million sale times the 2% discount. So now, when Apple collects from AT&T, AT&T is no longer paying $3 million. AT&T is paying $3 million minus the $60,000. So what we'll see then is the cash that Apple's receiving from AT&T is $2,940,000 because AT&T is taking the 2% discount. We're told that they paid within 10 days. Okay, so that's the cash being received. Now, from an accounting standpoint, we can't just say, oh, let's credit accounts receivable for $2,940,000 because AT&T is on our books at $3 million. So we need to get rid of this. We need to credit accounts receivable for $3 million. So then we have this mismatch. We have the $60,000 discount. What do we do with that? Well, what we do with it is we debit sales discount for $60,000. Sales discount is a contra revenue account. It offsets revenue. And then our credit will be to accounts receivable. So we need to wipe out our original accounts receivable, the $3 million. We need to have the cash that we're getting, and then the difference is that sales discount, and we need to record it as a separate, as sales discount because it is a contra revenue account. It reduces our gross sales. Okay, so that's a sales discount. Sales discount, that word discount is very, very precise. It means early payment incentive. And I know it's hard to think about, like if I go to the store and something's on sale, that is not a sales discount. A sales discount is early payment incentive. If we look at all our sales discount, that tells us how much in sales discount we've given for the year. That's very useful information. We don't want to just reduce sales for it. Okay, so we also have another thing called sales returns and allowances, which again is very specific terminology. This is the right to return unsatisfactory or damaged merchandise to the retailer for a refund or exchange. So, we'll go through this example and have another one. Suppose that of the 30,000 iPhones Apple sold to AT&T, 100 are returned because they're damaged in shipment. So what Apple going to do? So Apple is going to have to take back the 100 phones. So when they take back the 100 phones, they're going to take the value of the 100 phones, the sales returns and allowances. So the 100 times $100 is $10,000. We're going to debit this account called sales returns and allowances, and we're going to credit accounts receivable for the 100,000. Now, when Apple makes sales, I should say this, when Apple makes sales and when Apple gets its iPhones back returned to it, there's also another entry that goes on having to do with the inventory. So they obviously are going to have inventory come back, they'll have inventory go out. That actually when we make a sale, there's two entries. There's one for the sales revenue and then there's one for the cost of inventory. The cost of inventory, those whole things are going in the inventory chapter. We're not doing two sets of entries in this chapter. So just to keep it simple, so in case you're wondering, there is a second set of entries that occurs for sale of inventory, but we're not doing that in this chapter. So we have sales returns and allowances. That's also a contra revenue account. We keep track of that separate because that's good information to know. We want to know if our sales returns and allowances are huge. That's big information. That's good information to know. I want to know, are my sales returns and allowances increasing? Because that's something that would be certainly of value to know. Or is it decreasing? That's valuable as well. So that's a sales return. We can also have sales allowances. An example of that is my son bought a refrigerator from H.H. Gregg, and it was delivered. And when it was delivered, there was a small dent in the door of the refrigerator. So he pointed it out that there was this dent, and the delivery people called back to the headquarters, and headquarters said, okay, we'll take the refrigerator back. And if they'd taken the refrigerator back, they would have a sales returns and allowance for the refrigerator, for the value of the refrigerator. Or they offered him a $200 credit off the cost of the refrigerator for the dent. And so he took the $200 credit and put a magnet on the dent, so that made a lot of sense to him. So that $200 credit that they gave, that they said will knock $200 off the price of the refrigerator, that would be considered a sales allowance. Where something's wrong with the merchandise, you don't take it back, but you give some sort of reduction. That's a sales allowance. So we have sales returns and allowances. We have sales discounts, and when we mark something down on sale, that doesn't get recorded. We don't record sales until we get a sale price for them, and we record them at what we're selling them for. So if we've marked down merchandise for 25%, that doesn't get recorded. Yes? Right. The question is about why this goes to accounts receivable. This is Apple, okay? So AT&T had purchased the phones on account. So Apple had this accounts receivable for the $3 million. Okay, so AT&T is supposed to pay them the $3 million, but AT&T returned 100 of the phones, so they don't owe this $10,000 anymore. So that's why we're reducing accounts receivable. Yeah, and inventory is a completely separate. Yeah, but this is what they owe us. Okay, and again, sales returns and allowances and sales discounts are both contra revenue accounts. They're always shown with sales. They are not expense accounts. They offset revenues. So when we look at net sales is always our sales revenue less sales discounts, less sales returns and allowances. Okay, so what we're going to do now, we're going to do a couple questions. Yes. Okay. So first one. When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? Yeah, just a bill of lading is not an accounting term, it's a legal document that governs legal terms. But yeah, I mean, we talk about them. I mean, we don't talk about them, but yeah. Mm-hmm. Mm-hmm.
That's why I can understand.
Well, the bill of lading tells you the shipping terms. Yeah. Okay, when goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? We're going to close this in 5 seconds or so. Okay. And that is false. FOB shipping point would be when it leaves its docks. Okay, we're going to do a homework problem now. not this question. Okay, so short exercise 5-5, quick homework activity. We have a manufacturer sells a truckload of sporting goods to the store. The terms of the sale are FOB destination. The truck runs into bad weather on the way and doesn't arrive till January 2nd, 2015. The invoice is $308,000. The year end is December 31st. So what should the manufacturer reflect in its income statement? Okay, so there's one question, and then that's S-4, which is the basic facts for S5. So these are connected, 4 and 5. And then it talks about the sales terms on the invoice. So first thing, the sales terms on the invoice are 210 net 30. What does this mean? 210 net 30 means they get a 2% discount if it's paid within 10 days. Otherwise, the full amount is due in 30 days. Okay. Now, going back to the first part, 5-4, they sell a truckload of sporting goods. I thought I had a slide on this. I guess I don't. The terms of the sale are FOB destination. So FOB destination means this sale is not recognized until they receive the goods. So they receive the goods January 2nd. So that sale is not going to be on the 2014 income statement. It's going to be in 2015 because it didn't arrive and it's FOB destination. So it's not recorded. The sale is not recorded until January 2nd. Okay, so 210 net 30 means they will get a 2% discount if they pay the invoice within 10 days of the invoice date. Otherwise, the full amount is due within 30 days. Okay, so what is their potential savings? So they will have to pay $301,840. That would be the $308,000 minus 2%. I can take 2% of $308,000 and subtract it from $308,000, or I could take $308,000 times 98% to get the full invoice amount, the reduced invoice amount. So the savings, the 2%, would be $6,160. Okay, now the next question is kind of, you have to watch, because when we talk about credit terms, they're based on invoice date. Invoice date is a very clear date. Invoice date doesn't mean from the date you get it. It means from the date of the invoice. So the very next question, it says, how much time does the company have to take advantage of these savings? Well, it's 10 days from the invoice date. So if you go back to the original question, on December 23rd, they sold a truckload and they presumably invoiced it on that day. They don't wait to invoice it till it gets there. They do the invoice, they send the invoice, they ship the merchandise. So how much time? Assuming the invoice is dated December 23rd, they have to pay by January 2nd. So this is, you know, they could edit their terms, but normally you have to watch. It's from the invoice date. We're normally in our class, we're not going to split hairs like that. It'll be pretty clear what the invoice is, but it's a discount based on the invoice date. And they may do some adjusting in real life here if it was delayed, but typically it's saying we're going back to your invoice date. So you just need to read carefully the terms to see when the discount is based on. The discount is typically the invoice date. Okay, and I think that'll wrap it up for today, and we will start Wednesday with accounts receivable.